All right, so this chapter involves a lot of accounting. How many of you have taken at least one accounting class? That's it? All right. If you have some basic accounting knowledge, it'll help tremendously for this chapter. Okay? So if you can get hold of any accounting book, just maybe a couple of chapters, the financial statements chapters, right? If you understand those financial statements, it'll help you. Okay? Well, I'll try to go slowly, and I'll try to explain as much as possible. Okay? But I'm not an accounting professor, so I'm not sure whether I can give you the real firm understanding in accounting. Okay? But I'll try my best. Okay? Yeah, financial analysis. We're going to talk about financial ratios, a lot of financial ratios. And ratios are just the relationship between numbers. Okay? And using the financial ratios, we can quickly check and understand how a business is doing. Okay? It's like a vital sign. If you go to doctor or hospital, first thing they do is check your vital sign. Okay? Like your pulse, how fast your pulse is, your temperature, your blood pressure. Okay? So financial ratios are something like that, right? It's standardized, right? So you can compare your performance or company's performance over time, compared to the last year, how we are doing right now. Okay? Or you can also compare between companies, okay? Company A and company B, and by looking at these ratios, you can say, company A is doing better, or using resources more efficiently, while having the same amount of assets, they are generating more profit, something like that. Okay? So it is quite important. And if you want to understand corporate finance, that's the first step. Okay? Who uses financial ratios? Well, management, first of all. They need to know how they are doing. And in case they need to plan ahead, to plan for the future, right? They should be able to predict how their performance will be, right? Or are we in the right position to do this right now? Okay? Just like driving. When you drive, you need all those gauges, okay? Speedometer or odometer or fuel gauge and so on, okay? Without those things, driving will be dangerous, okay? Because you don't know how fast you are going, how far you can go, right? On current fuel. So management will use these ratios for planning and evaluating their performance. Credit managers will estimate the riskiness of potential borrowers or credit worthiness. I think in this class, perhaps I mentioned already that if you run a business, most of the times, well, I would say more than half the times, your task will be raising capital. Businesses constantly need money, right? So businesses always borrow money from banks or issue the bonds and issue commercial paper and so on, right? So when you go to a bank to borrow money, what do you have to do? I guess you have no idea, right? You haven't borrowed money from bank for business purpose, right? But typically you have to bring some documents, your business plan if you are starting a new business, right? But if you are running an existing business, you have to bring all your financial statements, okay? To show that how your business is doing, and to make to convince your credit manager, right? People who decide whether they're going to extend a loan or not. Okay? You have to convince them that you'll be able to pay them back, right? So for that purpose, you need to have all those financial ratios ready. And the credit managers see these financial ratios and they can quickly see how the company is doing. Okay? Investors, to evaluate corporate securities, before you buy any stocks, okay, you should do what's called the due diligence. Has anybody heard of this term? Due diligence, what does that mean, due diligence? You know the word diligently, due diligence. Okay? I'm sure you have heard of Warren Buffett. Who is he? Warren Buffett. Investor. World's second or third richest guy. Okay. Because number one is Bill Gates. Okay. His nickname is Oracle of Omaha. Omaha. Omaha is a city in Nebraska, okay? Near Lincoln, Nebraska. Okay? And his company, I believe, is located in Omaha, Nebraska. Okay? And he runs this investment company. Obviously, he is very successful. Okay? And if you're going to start in investing, right? If you're going to start in stock market, stock investing, I strongly recommend you buy at least one or two books from Warren Buffett and read about it, how he made his money, how he makes his investment. Okay? And what he says in his book is importance of due diligence. Okay? He would say before he dropped any single dime or any single dollar bill into any investment, he would pore over financial statements of the company. Okay? If you want to invest in Microsoft, for example, right, you should study all their financial statements. Right? Well, there are typically three main financial statements. Okay? We'll talk about that. You're taking notes on your smartphone? Oh, I see. Check whether I spelled it right or wrong. Okay. As long as you don't do texting, that's fine. All right. Investors evaluate the corporate. So before you make any investment, you should study the company's financial statements. Okay? That's what Warren Buffett recommends. Okay? And finally, managers to identify and assess potential merger candidates. Okay? I've been working as a advisory board director for a couple of companies. Okay? And through that experience, I have learned, companies expand. I mean, you have to constantly expand. Okay? Otherwise, you'll be behind. You'll get behind in competition with other companies. Okay? So if you become a high position CEO or near CEO, vice president position, people constantly look for target for acquisition. Okay? And when company grows, one company expands, I mean, you might think that they may just build a new plant if the business is running well, right? But more than any other ways, okay, most of the times I would say, companies expand by acquiring existing businesses rather than building a new plant. You understand why? Can you understand why? Okay. Because if you want to build a new plant in a new city or a new location, that involves a risk. Okay? Because you never tested your business in this new location. Okay? and then it takes time to plan and actually construct the plants, right? And then you have to hire the new workers, right? So there is a lot of risk and cost involved, okay? But if you can identify an existing business and you can just purchase or acquire this existing business, the cost is a lot lower in terms of risk and the delayed time and so on. Okay? So if you are running business and the business is doing well, you'll probably look for candidates, always look for candidates to acquire. Okay? Because there are always companies that are not doing so well, and they are for various reasons they are trying to sell their company. Okay? And when you decide, whether you will buy this company or not, or what company, if you have several candidates, you have to choose one, right? And when you do that, you need to look at the financial statements of these businesses, right, and see how they're doing, right? Talking about this Warren Buffett, just a side issue, since we are talking about stocks. Okay? There is Berkshire Hathaway. This is a company. It's like a mutual fund. Okay? This is, so to speak, the mutual fund that Warren Buffett runs. Okay? And of course, this is a combination of all kinds of companies. Geico, starting from Geico. GEICO actually stands for Government Employee Insurance Company, something like that, right? So it started as a government employee insurance, providing insurance for government employee. But these days, anybody can buy insurance, automobile insurance, or many other insurance from this Geico company, which is, one of the largest insurance companies. Okay? And of course, the company is doing well and making a lot of money. Okay? So there is a Berkshire Hathaway stock, and the ticker symbol is BRK. Okay? It's like Microsoft is MSFT. AT&T is T, something like that. It's called the ticker symbol. Okay? We'll talk about those things. Okay? There are actually A shares and B shares. There are two different types of Berkshire Hathaway. Okay? And the price of one stock, one share, BRKA, is about, I would say, 185. Yeah, 185,000. Just for one share, $185,000. Okay? Dollars. Yeah. And B share is pretty cheap. It's about $125. Okay? So when we talk about stocks in probably chapter 6, we'll talk about it more exactly. What's the difference between A shares and B shares? Okay? The main difference is voting right. Stockholders have voting right. Okay? And let's see, what was the number? Yeah. B share own. If you own one share of BRKB, you have 1 over 10,000. 1/10,000th of the voting right of A share owner. So it's like if they have a stockholders meeting, okay? If you own one share of BRKA, you get 10,000 votes, right? And if you own B share, you get just one vote. Okay? So there's a significant difference in the how to participate in the management of the company. okay, if you have a lot of votes. So about 10 years ago, maybe 15 years ago, it wasn't that expensive. It was something like $15,000. Okay? And at that time, people would buy just one share of BRKA, $15,000. Okay? The idea is not to make money, but to receive a newsletter. Okay? If you become the owner of BRK, Berkshire Hathaway stock, right? You will receive monthly newsletter from Warren Buffett, okay? And you can see what companies he invests in. Okay? So people would, I guess, simulate, okay? Or copy, what Warren Buffett does in his own investment. Okay? So that was the idea. All right, so here we go. We have key financial statements. There are 3 financial statements. The first one is balance sheet. Okay? Balance sheet lists all the assets and liabilities. Okay? In typical accounting, we list assets on the left-hand side, liabilities on the right-hand side, liabilities and equity. Okay. Assets are what you own, all the buildings and equipment and stocks and all your properties, okay? The values of all the assets. Okay? And then you list all the liabilities, how much you owe, the money you borrowed, okay? And so on. Okay? And the name balance sheet comes from the fact that the total assets and total liabilities and equities must always be equal. The balance sheet must be balanced all the time. Okay? Why does it happen? Again, I'm not an accounting professor, but let me give you a very simple example. Okay? Suppose you buy a car. You go out and buy a car worth $10,000. Okay? And suppose you made a $2,000 down payment. You save money, and $2,000 down payment. Actually, my second daughter just did it a couple of weeks ago. Okay. I guess this is the first time she bought her own car with her own money. Okay. And made $2,000 down payment. Of course, the actual car was about $30,000, $35,000. Mazda 3. I recommended Hyundai Elantra. Elantra is actually, in Korea it's called the Avante, right? And in the United States, Elantra. Okay? But, well, the new Mazda 3 has pretty good reputation. Anyway, so if you did that, then you have to borrow $8,000. So in that case, your balance sheet would look like this. You have your car. Car is an asset, right? And the value of asset is $10,000. Car. Okay. Of course, value will go down as the time goes by, right? But immediately after the purchase, you have your car worth $10,000, okay? And then you have your loan of $8,000, That's your liability. You owe that money to bank or someplace, right? You borrowed money from. Okay? And then you have your equity. In other words, if we sell the car today at $10,000, right? Then after paying back $8,000 loan, you will have your real worth or net worth of $2,000 because you made $2,000 down payment, right? So that's your equity. Okay? So total asset would be 10,000. Total liabilities and equity will be 10,000. Okay? Or if you take accounting class, you will learn a little more in detail. It's called the double entry system. Okay? Just to make everything's correct and some, the idea of checks and balance to make sure everything's, nothing is missed. Okay? They use double entry system. Okay? So you can say this is a result of double entry system. You list on asset side and list on liabilities and equity sides, and both sides must be equal all the time. That's a principle, right? All right, so that's the idea of balance sheet. Okay? Balance sheet is the snapshot view of financial health. They typically say this is a snapshot view of the financial health of a company. Okay? In other words, balance sheet is constructed at one point in time. So typically on top here, balance sheet of company XYZ or ABC, and then it should say as of the date, right? Typically it is constructed at the end of year, December 31st, 2010, or many times you see quarterly balance sheet, right, at the end of 3 months period. Okay, so balance sheet always has to have the date. When is it? As of when? Okay, so that's the idea of snapshot. It's just like taking a picture of a company at the moment. Okay. All right, here's an example. Brake manufacturing company balance sheet in thousands of dollars. Make it a little bit larger. Okay. So it starts with assets. In accounting principles book, you learn balance sheet this way: the assets on the left-hand side, liabilities on the right-hand side. Okay. But in many practical cases, when a company is issued their financial statements, you see this form. You list all the assets on the top and liabilities and equity at the bottom. Okay? And of course, the total asset must be equal to total liabilities and equity at the bottom. Okay? All right. Assets first. The rule is, there are many different types of assets, right? But you should start with the most liquid asset. And I think we talked about liquidity last time, right? Liquidity means how easy it is to convert into medium of purchase. So, among all the assets, you can have stocks and bonds, or machineries and plants and buildings, right? Which one is more easier, or how quickly you can convert it into cash? All right. So most liquid asset is of course cash. Right? You can use it immediately. Right? So cash value is 2,540. If you read on top, it says in thousands of dollars. So 2,540 means actually $2,540,000. Okay. And here's the time. December 31st, 2010. Right? And many times, for comparison purpose, they put two periods together. Right? So this is 1 year ago, and this is maybe this year, something like that. All right. Marketable securities, something like stocks and bonds that you can sell in the market. Okay? The financial securities that you can trade or sell in the market. So in case you need money, you can go out and sell these stocks and bonds and convert them into cash. So pretty liquid. Account receivable. Where's some credit sales. So when you sell your products, some customers pay cash, but in businesses, they seldom pay cash, right? So you ship your products to customer, and you also send the invoice, okay? And invoice, you list all the prices and the total payments, right? And usually it says the total payment is due 15 days or 30 days, something like that. You can even have 3 months in case you're shipping the products overseas, right? So account receivable means you've made the sales, but this money has not been collected. Okay? So it is an asset because you have a claim on this money, right? But it's not really available immediately, right? So it's slightly less liquid account receivable. In the worst case, you can actually, for some reason, if the company goes down, you need to close the company, declare bankruptcy, right? Then, it may be difficult to convert account receivable. It may be difficult to collect all the AR in short period of time, right? And in that case, you can actually sell account receivables to other companies, okay? But usually that involves a severe discount, okay? If the total value is $100,000, okay, maybe you can receive only $20,000. Okay? Inventories are part of assets. Okay? There are typically two different types of inventories. Okay? Maybe you have produced your items. Suppose you're producing computers, right? So you've already produced maybe hundreds of computers, and these are not sold yet. Okay? So those computers are sitting in your warehouse. Okay? That's already produced inventory, finished products, right? But the other type of inventory is a lot of materials and components. Maybe you have purchased the materials that you use to assemble computers, or components like hard drives or LCD screens and all kinds of things, the printed board, CCD pieces, or printed circuit boards. Okay? So those are all inventories. Okay? So these items, starting from cash, marketable securities, account receivable, and inventories, okay? These are typically considered the current asset. Current assets mean that you can convert these items into cash within relatively short period of time. Okay? What do you mean by relatively short period of time? Typically 1 year. In accounting, right? They use 1 year, right? They believe that these items can be converted into cash within 1 year if you want to, right? So it's called current asset. Okay? Plant and equipment, including buildings, right? So if you have all other equipments, right, or buildings and facilities and machineries, tools, right, all those things, right, are considered fixed assets. Instead of long-term asset, it's typically called a fixed asset. Okay? And fixed asset simply means it takes more than a year, or it is expected to take more than a year to convert them into cash. Alright? So from the total value, gross value of fixed asset, typically they subtract accumulated depreciation, depending on how old these equipments are. Okay? If you have a car which is 10 years old, okay, then the car may not have any marketable value, right? Or very small marketable value, right? So when you list the values of your asset, you have to consider as accumulated depreciation. So you subtract the accumulated depreciation and you come up with a net plant and equipment or net fixed asset. Okay? So the value of net fixed asset is here. Okay? So finally, when you add them up, come up with the total asset. This company has $81,890,000 worth of total asset. All right? Liability on the equity side. Well, again, we start with the short term first. Account payable, AP. Okay? This is the other side of AR. Okay? Account receivable. Okay? Accounts payable means you purchased some items from your suppliers, but you have not made payments yet. Okay? So you purchase those supplies and materials or components, okay, on credit. Okay? So you need to make the payments within pretty short period of time. So the accounts payable. Okay? Notes payable, this amount of money you borrow, okay? Short-term loan. Okay? And typically you can get some short-term loan from the bank, and typically you list interest rate that you are making on this money, okay, borrowed. Okay. Notes payable. Notes payable, well, it's, or IOUs, okay, the debt security, debt instrument, debt certificate, or documents that indicating that you have borrowed money. Okay. But depending on the maturity, if the maturity is longer than a year, it's called bond. Okay? If the longer maturity is less than a year, or maybe up to a year, okay, it is called notes. So that's the only difference between notes and bonds. Okay? Short-term versus long-term. Accrued taxes payable. Okay? So this is what we typically call accrual. Accrual. Okay. So let's say you make income tax payments once a year. Okay. But let's say this is March, end of March. Okay. Then if you expect, say, $10,000 income tax within this year. Okay? Since this is end of March, that means 1/4 of the year has passed. Okay? So that means you've already accrued 1/4 of $10,000 or $2,500. Okay? So even though you don't have to make the payments until the end of the year, you still have, 9 months left, okay? But you should have saved this money in principle. That's the idea of accrual, okay? So you already owe about $2,500 in taxes, okay? That's the idea of taxes accrual, accrued, or payable. Other current liabilities. What can be other current liabilities? Suppose you make salary payments at the end of the month, every month, right? In Korea, I guess most people get paid on 25th, right? On 25th, okay? So today is, let's say, 10th, March 10th. That means we are right in the middle of February 25th and March 25th. Okay? So that means even though you don't have to make payments to your workers until the 25th, right? you've already used their services for half the month, right? So you owe them half the month of salary. Okay? And if your total salary amount is 100,000, let's say, every month, right? Then as of today, if you're talking about today, March 10th, let's say, then you have accrued 50,000 worth of labor wage services, wage payment. Okay? So that's the idea of other liabilities, maybe. Okay? But you can think of many other liabilities. Electric bills, all kinds of bills when you make the payment. Okay? So these items here, the first four items, you can consider short-term liabilities or current liabilities. Okay? And then we are moving into I guess we have one more. The current portion of long-term debt. Okay? So you have borrowed this money for the long term. Okay? You issue the, maybe not bond. Yeah, let's say bond. Okay? Let's say you issue 20-year bond. Okay? And it's been 10 years. So you still have 10 more years until you pay back the principal. Okay? But you need to make semi-annual interest payment. Usually when you issue a bond, you make the interest payment every 6 months. Okay? So you have to consider the current portion of the long-term liability. Okay? Now how much money you need to get ready to make the payments maybe this month or 3 months later, something like that. Right, similar to accrual. Okay?
But the accrual is related to
Related to, I'm sorry, what?
tax.
Yeah, it could be taxes, it could be wage bills, but we're simply separating out the long-term debt here, right? Because we have long-term debt coming here, right? But part of usually when you issue a bond, you can consider that the bond is a long-term liability, right? But related to the bond, there is some short-term liability like semi-annual interest payment. That's what this is. Does it make sense? Do you have a question? All right. So starting from the long-term liability, we have long-term debt, which is typically bond. Right? So here they have issued the 9.58% mortgage bond. Mortgage bond simply means when they issue the bond, they have put up a collateral. Okay? So in case they do not pay it back, in case they fail to pay it back, the investor is going to come and take away your equipment or building or whatever, right? Or land, okay? Whatever the collateral you put up. Okay? Why would you? I mean, most of the bonds, the simple bonds, you don't have to provide any collateral. Okay? Mostly the bonds are based on your credit. Okay? But why would you put up a collateral? Either you have pretty bad credit and investors require it, okay? Or you can actually bring the interest rates down by providing the collateral, issuing a mortgage bond. Okay? You can lower the interest charge. Okay? Because for investors it's slightly safer, right? In case company fails to pay back, you can come and take away their equipment or plant, right? All right. So when you add them up, total liabilities come 47,000 or 47,523,000. Okay. So here we go. Ultimately, total assets must be equal to total liabilities and equities, right? And we have, say, 10 here and 20 here, or 80 here. Okay. then this equity here will make up the difference. Okay? So in reality, I mean, if you think about the real situation, when you list, I mean, this is just a simple hypothetical example, right? In reality, it's quite complicated. There are so many different minor detailed items, right? And when you just list all the assets and all the liabilities, it's pretty unrealistic that those two numbers will come out equal. Okay? So in reality, this equity, stockholders' equity, is used to make up the difference, make up for the difference between assets and liability. Okay? And so that at the bottom line, okay, these two numbers will match. Okay? All right? But here are some concepts related to stockholders' equity. Okay? First of all, you know, equity, again, is, you can say it's a net worth. Okay? Just like this example, right? If you purchase the car, $10,000 car with $8,000 loan, right? Then you have $2,000 equity in your car. In other words, that's the net worth, your actual net worth of the car you own. Right? The rest, $8,000, is not yours. You owe it to someone else, right? But you own this value, $2,000, right? So stockholders' equity means in all this company, your company can be pretty large and can have many different plants and buildings and equipments and everything, right? But out of all this, what is the net worth of actual owners? Okay? That's the idea of stockholders' equity. Okay? So first thing we list is the stock value, common stock. $10 par value. This is another weird term. Par value. This is not the stock price. It has nothing to do with the market value of the stock, right? How much is the Apple stock these days? Nobody follows? Okay. Let's say $600. Okay. The market price may be $600 a share, right? But par value may be, you can find it out if you go to Yahoo Finance and check the Apple financial statements, right? But par value may be $1 per stock per share, or $10 per share, right? So par value is just a simple artificial value assigned, okay, for accounting purpose only. It has nothing to do with market value or actual worth of the stock. Right? So in this company, it says $10 par value, and the total worth, the value of the stock is $13,000 or $13 million. Right? So that means they have issued what? 1.3 shares outstanding, right? $10 times 1.3 million would be 13 million. Okay? So while there are 1.3 million shares issued and outstanding in the company, okay, they just, for accounting purpose, they assign the $10 per par value. Okay? I have created a couple of companies. It's called S Corporation. S Corporation, its actually full name is Subchapter S Corporation. Okay? It's a corporation. It's a limited liability company. Okay? But it usually has single owner. Okay? So we talked about the proprietorship. But the downside of proprietorship is full liability. Okay? In case business goes down, you have to sell your house and car and everything to pay back the business loan. Okay? But if you declare S Corporation, it's just like corporation, limited liability. Okay? So as long as you separate your business account with your personal account, okay, business can go bad and you can declare bankruptcy on your business, but they cannot touch your personal assets and personal money. Okay? So I have created at least 3 as corporation. Okay? And when you declare as corporation on the paper, when you file the paperwork, you have to issue stocks. And you have to list par value of stocks. Okay? And I usually say 1,000 shares at $1 each, par value. Okay? Because after all, I am 100% owner of the entire stock. Right? I'm not selling these stocks to anybody. Right? But because in format it is a corporation, you have to have stocks and declare the par value of the stocks. Okay? And also how many shares you issue. Okay, so that's the par value, and this is the par value of the stock. Okay? Contributed capital in excess of par. Okay? So you start the business. Let's say I'm starting the business with $20,000. Okay, that's my initial investment. Okay, but I declare $1 par value and I issue 1,000 shares. Then the par value of the company is only $1,000. Okay. And then the rest, $19,000. Okay. It will be contributed capital in excess of par. Right? Get the feeling? Okay. Because I am investing that much money in this company to start the business, but the value of the stocks is pretty small. Okay? But I have contributed other than the cost of stock. Okay? Well, as we go on, we'll have to deal with this concept repeatedly, and you'll see more exactly the concept. I'm sure some of these concepts are not really clear to you at this point. So, retained earnings. It's when company makes profit, then the profit is supposed to be shared by owners, right? Who are the owners? Stockholders, right? So if you share your profit with stockholders, it's called what? Dividend. Dividends. Right? But for many reasons, for many times, for a variety of reasons, companies may not share 100% of their profit, right? In fact, many technology companies, they never pay any dividend. Microsoft, for example, okay? Microsoft started, I believe, in 1979 or 1980. Their first PC was 1981. Okay? But for about 25 years, Microsoft has never paid a single dime in dividend. They never share the profit with the shareholders. Okay? So why would you invest in this company? Right? You invest your money and purchase their stock, and they never share any profit with you. Why would you buy their stock?
If the price of the stock goes up.
Exactly. Because most investors, they are not interested in dividends, okay? But they are interested in capital gain. Okay? Buy low, sell high. You learned this, right? That's the first principle in stock investment. Buy low, sell high. Okay? So, when you buy when the stock is cheap and sell when the stock appreciates, you make capital gain. That's what most of the people, most stock investors are about, right? They are not interested in dividends. Okay? So there are a few different types of stock: growth stocks versus income stock. Okay? Growth stock means these stocks are expected to appreciate quickly, okay? And you make a lot of capital gains. But some other stocks like what's that cigarette company? I can't think of the name. The largest cigarette company. Yeah, the company that makes Marlboro. What? Anyway, there are income stocks. Income stocks means these companies typically make dividends regularly, right, without ever missing. Dividends are typically paid every 3 months, every quarter, right? So investors can actually expect to make some money out of dividend, right? But many times, as I said, the growth companies like Microsoft, Intel, or Google, all these technology companies, they don't make any dividend payments, right? What do? I mean, what's the reason? What's the justification? You invested in this company and you are the owner, and why don't they share profit with you? Retained earnings. What's the justification? How can the company retain all the profit without this reinvestment? Yes, that's typical reason. Right? Reinvestment. Company says, well, we are growing fast, so next year we need to build another plant. Okay? Next year we need to buy another company. Okay? So we expect to use this, profit for such and such purpose, and they can say, sorry, no dividend this year. Okay? So that's the idea of retained earnings. Okay? So out of the net income or profit, the next financial statement is income statement. You will see, right? From the total sales, you subtract all the costs, and you come up with the operating income or gross profit. Right? And from the gross profit, you subtract all the interest payments and all the financial costs. And finally, what we call bottom line. Okay? Bottom line is net profit. Okay? And what do they do with net profit? It could be retained. Part of the net profit could be dividend. The rest will be retained. All right. Anyway, so here this company has $11 million retained earnings. Remember, this is accumulated. Right? This is not just 1 year or 1 quarter period. Right? This is accumulated retained earnings so far. Right? So they have $11 million worth of asset or equity. Right? So if you add them up, you come up with the stockholders' equity. Add them up, you come up with 81.89. Again, realistically, if you just count all those items individually and add them up, these two numbers, it's highly unlikely that these two numbers will be equal, right? But then, where do you, in case they are different, where do you make adjustments? Right here. Typically, contributed capital in excess of cost, right? Just to make two numbers equal. Do you understand what I'm saying here? Okay. Key financial statement, which is an income statement. Okay? An income statement starts from net sales. Net sales is total sales minus returns and discounts. Okay? So out of all the items you sold, some of them are returned, some of them you gave some discounts, right? So when you subtract those things, you end up with net sales, okay? And from the net sales, you subtract cost of sales, okay? And cost of sales is basically production cost, okay? Include all the material and wages and other the expenses for the purpose of production of your item, your final goods, okay?
And then you will end up with gross profit. Okay? So from the net sales, you subtract cost of sales, you come up with gross margin. Okay? And here are the numbers. Okay? And from the gross margin, you subtract operating expenses. Typically, if you look at the typical accounting, the income statement, they would say SGA. Okay? Selling and general administrative. Selling cost, general and administrative costs. Okay? But selling cost, promotion, advertisement, in order to sell, you have to advertise your products. And also if you hire some salespeople, you have to pay their, fees. What do you call that? Commission, right? Salespeople, you pay commission, okay? So all those things belong to selling cost, okay? Administrative, you have to, have office space, and you have to pay, the sales, the clerk, and so on, right? All the people doing some administration. And then there are some other general expenses like electric bills and, cleaning bills and all kinds of bills, okay? So that's what we call typical SGA, okay? Expenses, okay? So that's, in other words, operating expenses, SGA, okay? All right, so when you subtract operating expenses from the gross margin, you come up with the EBIT, or EBIT, okay? Earnings before interest and taxes, okay? And EBIT, in other words, is operating, you can say it's operating income, okay? So from the gross sales, you subtract these items and come up with operating income, okay? It's, just earnings before you pay interest and taxes, EBIT, okay? So, basically how much money you made out of the operation, production and selling, okay? And now the rest of the course, the items here, the costs are, you can say, financing costs, okay? So, again, most of the companies borrow money to start the business and purchase the equipment and so on. Okay? So there will be interest expenses. Okay? So you subtract interest expense, okay? And then you arrive to finally to EBT, earnings before taxes. Okay? And from the EBT you subtract federal and state and all kinds of taxes. Okay? You come up with the EAT, earnings after taxes. Okay? Earnings after taxes is, in other words, net income. It actually has many different names. Net income, net earnings, net profits. Sometimes it's called the bottom line. I'm sure you have heard of bottom line. Okay? Many times they ask, well, what's your bottom line? Okay? What's your point? Something like that, right? So when you have the income statement, in many cases, this EAT is the bottom line. That's the last line, typically. Okay? Other information is, these things are not necessary. Okay? Typically, you don't have to have these items in any income statement. Okay? But many cases, they include this as a supplemental information. Okay? But that's not essential part of income statement. Okay? So in the typical income statement, EAT, net income or net profit, is the bottom line. It's the last line. Okay? Okay. And sometimes we talk about common size financial statements. Okay? And this is not any separate financial statements. We still talk about the balance sheet and income statement. But instead of putting actual numbers, we put percentages, okay? Just like this. Okay? So this is a common size balance sheet. Instead of seeing actual dollar figures in these spaces, right, you see all percentages. Okay? So cash holding is 3.1% of total assets. Okay? So one thing you have to understand is when you construct a common size balance sheet, all the numbers have to be converted into percentages of the total asset. Total asset. Okay? Percentages of total asset. And of course in balance sheet, total asset is equal to total liabilities and stockholders' equity. Okay? So you can say either way. Okay? So all those numbers are percentages of total assets or percentages of total liabilities and equity. Okay? So that's the case of balance sheet. In the case of income statement, common size income statement, again, instead of dollar figures, we look at percentages. Percentages of what? In the case of income statement. Net sales, yes, the top line here. Income statement always starts from net sales. Okay? So convert all the dollar figures into percentages of net sales. Okay? And you will see, well, that's how you construct the common size income statement. Okay? Why do we do that? What's the purpose of common sized financial statements? Is it better than the dollar figure tables? How? How is it better?
Is to figure out how many percentages they.
Okay, right. So basically it shows the proportion of each item to the total assets and total sales. Okay? So it is quite convenient, first of all, if you want to compare what happened over the years, okay, within your company, right? So for example, here, cost of sales, okay? This year, cost of sales was 75% of the net sales, okay? But is it going down or up over the years, okay? Increasing or decreasing? If you want to do that, instead of looking at all the numbers, because if you look at the dollar figure table over the years, then there's net sales will be different. Okay? So it's going to be difficult to just quickly look at the proportion of the production. Remember, cost of sales is production cost. Okay? So if you want to find out, if the question you are asking is, are we becoming more efficient in producing or less efficient in production? Okay? Are we using our materials and labor more efficiently or less efficiently? Okay? Then you want to look at the proportion or percentages of cost of sales to the net sales. Okay? So by having this common-sized income statement, you should be able to figure it out quickly. Okay? Also, in the case of balance sheet, if you look at the common-sized balance sheet, right? Say inventory here, right? What's happening with our inventory, or what's happening with our current liability, right? We can quickly see what happened from last year to this year. Yeah, there was a significant increase in current liability. Okay? So that's the first use of common-sized financial statement. You can compare different years within the company. Okay? Another purpose of common-sized financial statement is in case you want to compare across different companies. Okay? What's happening from company between company A and company B? What's the difference? Okay? And if this is company A and if this is company B, you can quickly see, company A has a lot more current liability in terms as a percentage of total assets, right? Compared to company B, right? So in case you are hunting for acquisition candidate, okay, then you can quickly compare company A and company B in all their financial standings and what's happening. Okay? Does it make sense? Okay? So that's the purpose of common-sized financial statements. The last of the key financial statements is cash flow statement. Okay? And we're not going to talk about in detail in this chapter because this is actually the topic of chapter 4, next chapter. Okay? Next chapter, the title is what? Financial planning and forecast. Okay? And basically what we're trying to find out in chapter 4 is, does the company have enough cash to handle the future project? Okay? And how much cash do we need to handle all what's coming, what's planned, or what's in trend in the future, right? So we'll talk about the cash flow statement in detail in chapter 4. Okay? But here, just to emphasize the importance of cash flow, okay? The incomes data, what we just looked at from the income statement, okay? Or the sales and net income and gross income and whatever, right? Operating income, okay? Those numbers can be misleading due to recognition of revenues that have not been received, okay? In other words, sometimes as soon as you sell the product, you list it as your sales, okay? But, many times those sales are credit sales, okay? And the money has not been received yet, okay? So for the purpose of planning, say you want to plan for the next month or 6 months later or 3 months later, how much money you need 3 months later, right? You cannot use those sales figures. Okay? You have to use actual cash you have. Okay? Another problem with these income figures is allocation of costs over future time periods. Okay? It has to do with depreciation. Okay? When a company purchases an equipment, suppose your company purchased $10 million equipment last week. Okay? Then what happens is, you could have paid $10 million in cash, or you could have financed over, next few years. Okay? But in terms of bookkeeping, when you list in your income statement, you cannot deduct $10 million all at once. Okay? According to the accounting regulation, okay? Depending on what equipments we're talking about. If it's a car, for example, I don't think there is any car for $10 million. Okay? But let's say a very expensive equipment or a huge truck or something, right? Specialized truck or vehicle. Okay? There is a tax regulation on how many years you can deduct this cost over how many years. Okay? So there are 5-year equipment, 7-year equipment, and 10-year equipment, something like that, depending on what the equipment you're talking about. I think a computer is typically 5-year equipment. Okay? So if you purchase the computer, suppose even if you paid cash yesterday, okay, you cannot deduct the entire cost of computer today or this year or this month. Okay? You have to distribute that cost over the next few years. Okay? So that's what we're talking about, allocation of costs over future time periods. Right? So there is a discrepancy between your actual cash holdings and the amount of money shows up in income statement. So if you have purchased, say, $10,000 computer, okay? Since this is a 5-year equipment, every year, starting from end of this year, you will be able to deduct $2,000. Okay? So in the income statement, you still have $8,000. By the end of this year, your deduction is only $2,000. So you should have at least still $8,000 remaining. Okay? But in reality, you've already paid $10,000 out of your pocket or out of your bank account. Right? So there is a difference between the income statement and cash flow statement. Okay? So if you want to get prepared for your cash expenses next month or 3 months later, which one should you believe? Income statement or cash flow statement? Cash flow statement. That's very important. The companies with good earnings, suppose your products are selling well, and in your income statement you are making good profit, still, for some reason, if you have unhealthy cash flows, somehow you're not collecting your sales that well. Your customers are not paying. So your customer may be having some financial trouble, and they are delaying the payments. Then the company can get into trouble if you're cash strapped. Your bills are coming, you issue the bonds, and the bonds are maturing, right? So you need to redeem your bonds. Basically, you need to pay back the money you borrowed. But if you have insufficient cash, what can you do? You have to either borrow more, but if you're unable to pay existing bond, it may be difficult to borrow any further, and your credit rating may be downgraded, and you have to pay high interest rate and so on. In the worst case, you may have to declare bankruptcy in order to protect yourself from investors. So cash is king. That's what they say in business. Cash is king. You have to pay attention to how much cash you have. You cannot trust just the income statement. All right.